If you ask me in 5 years, is gold higher than it is now? Absolutely. It's at all-time highs, maybe even $10,000 an ounce. But the idea here is that what we see investors in terms of their behavior is that if the stock market dumps, they panic, they get margin calls, they dump gold, right? You can see that all across past history. And that's what we're looking at here is a scenario where you see more of a deleveraging event that involves gold and silver being caught up in it. That ultimately takes it down in the short term, meaning by year end. Then it starts to regain the whole bigger trade narrative, which you mentioned beautifully, that I totally agree in. So again, it's the difference here between looking at the long term or the very short term, which to me is the next 7 or 8 months, right? Gold is usually a safe haven asset. In other words, it should have been roaring the last 2 weeks with this conflict with Iran, and instead it's actually been weak. If we turn to the charts here, take a look at this. So I want to draw my attention on the charts to this period going into the final run up on gold. This, just like silver, was where momentum and emotion took over. That's what had to be wiped out right there with the drop back to 4,400. Since then, what we've created is a bear flag situation. Now, I want to be crystal clear, and I talked about this with Michelle ahead of time, is that I have not sold 1 ounce of my physical gold or silver. But on a swing trade basis, does gold in the near term say it's going lower? Yes, it does. Not only is this pattern bearish, but then we broke here. This is another bear flag, and you can see us starting to roll over. So short term, I'm looking over the next month or so, we should reattack the 44 to 4,300 level. And I know people aren't going to want to hear this, but I think in fear and panic, we are going to see a move down here to $3,500 per ounce by year end. Now, at that point, I'm buying more physical. I'm not buying physical till then. I've got enough. If it gets down to 3,500, I will buy physical gold at that point. The run-up in gold was a classic diversify against fiat currencies money until we got in that last move up. That's when emotional investors played the FOMO game. They just ran in because it was the easy trade. We saw this with silver. Those buyers that bought for the wrong reasons, the get-rich-quick reasons, they need to be washed out. And as fear envelops the whole system, just like it did with COVID, when we saw COVID, remember, COVID hit March 2020, we saw gold actually dump out. That's what's going to happen here on gold. You're going to see a flush out of the weak hands. It's going to dump out to about 3,500. Then it goes back to a safe haven trade and an offset for fiat currencies. And I think you start climbing back to all-time highs within another year or two. Fear is the most pervasive trigger for everything.
But is it
and
fear?
Once you see that spike, you will see that gold sell off. And again, just drawing back to the same thing, because you mentioned all the central bank buying. I agree with all of that. But again, in the short term, fear again will rule the day and essentially create a selling and ultimate buying opportunity in gold. So it does after the dust settles, right? And so again, I would just harken back to past periods where we saw gold going up, and then something occurs in the bigger macro picture in the economy, like just like we saw during the COVID period of the 2020. But you can go back in history and look, when you see panic actually hit, the initial response is sell everything, ask questions later. And then once people start asking questions, they start to say, okay, wait, now let me see. I won't buy stocks, but let me at least get my money back in gold. And I think that's what's going to happen here. And for those of us like me that love gold long-term like you, it's going to be a fantastic buying opportunity. My only thing is human psychology. And so I study human psychology, which has helped me trade so well and make these type of calls. And human psychology, again, the same arguments are made. In fact, when silver was at $120 per ounce, and I said, guys, it's going to dump out here, be careful. I heard, well, this time is different. No, it's not. All of the same things, and then it dumps back to the $80, $70 level. That's human psychology. And while you can utilize that to make trades in the short term, the longer term macro, which you've eloquently said, that will be the longer term play. Gold within 2 to 3 years is north of 7,500, likely within 5 years to 10K. And again, the same reasons that you stated, I 100% agree with on those in terms of the debasement situation, de-dollarization, central banks continuing to try to diversify away from US dollars. There just has to be this flush out, or likely will be this flush out first. Get rid of the weak hands, let the emotion get out of the gold market, and then let it start a healthy climb to the upside like it was before this last surge up. And I do think that's a possibility. We'll have to see how this all pans out. I don't think it changes the long-term trajectory, but you're right. In the short term, that could be an added push to gold to the downside. That could be. I think longer term, even what's going on with Iran is making more and more countries aware of how much power the U.S. yields with that reserve currency, and it will ultimately make central banks continue to buy, even if in the near term, like we're talking about, we head to $3,500 per ounce. Based on the charts, and especially if gold is going to 3,500, silver should still pull back to about $50 a barrel. If we take a look at my silver chart here, we can see that, again, we're now stuck in what we would refer to as a bear flag formation. Bear flags where you have a big drawdown, and then you go sideways like this, and that generally results in a down move. And you can see it right here, sideways chop, and then ultimately we're even starting now to roll over. So while I don't think by the end, I mean, literally in 2 weeks, we'd have to be at 50. So I don't think that's going to happen within my stated time frame. The last time we talked, I do think it does happen this year. I will stick to my $50 call on silver. And again, it's not going to be a popular statement, but same thing here. This is really what you look for, the retrace here. If we go to the zoomed out chart, we get down to about $50. We retest the 1980 high and the 2011 high. And in technical analysis, I'll just show this real quick lesson on TA, is that when you have a chart that comes up, you break down, you go up, you break down, and you finally break out, there's a tendency for price to want to go retest that line before it makes its next big move up. And that's essentially what we would expect to see here in silver. And so again, what's going to be the trigger? Deleveraging, my guess, kind of the same thing as we've talked about with gold, is that you'll see that pullback. And of course, you'll see the comments, this time is different, the supply, the paper supply versus physical. I get all that. And that makes sense to me in the long term, but it doesn't change the near-term drawdown scenario where you see a liquidity flush out, a margin flush out, and we see a pullback to $50. So I'm going to stick with that. Just again, maybe give me another quarter on that one. I think it's going well above $120. And again, just like you mentioned, great factors on gold, the longer term, same thing. The applications of silver. Silver, again, is a major byproduct of iron and lead mining, right? And ultimately, what we're seeing here is that no one's really mining silver per se to mine silver, at least not right now. It's just that byproduct. And I think ultimately that's one of the best bull cases for silver over the long term, is that, again, that's going to draw out less and less supply with the industrial demand for the industrial complex, essentially missiles, et cetera. And that's going to drive it much, much higher down the line. So I would think $200, if gold hits, let's say 7,500, I would think you're at $200 to $250 on silver within 2 to 3 years. In all fairness, in silver, when it dumped out from 120 back into 70, I did go long on that scenario for the bounce, and then I got out right away. So I want to be clear on that. But the best thing for us here is to understand that I still hold every ounce of physical gold and silver that I bought over the last 10, 15 years, and I don't plan on selling those anytime soon. I'm going to hold those basically as an insurance policy for the continued debasement of the U.S. currency and fiat currencies overall. When the near-term inflation is going to go up, and unfortunately, this is going to hurt a lot of middle-income and lower-income individuals who have already been crushed by inflation over the last 5+ years, right? And so we're looking at a scenario where you have the middle income already starting to cut back. This used to be a market, if you look back a couple years ago, where the low income, they were the ones cutting back, but the consumers in the middle income and the higher income were still spending. Now the middle income's falling to the wayside, and the economy is just running on the higher income, which is likely based mostly off the stock market returns. Now that we're starting to see a rounded top on the S&P and a move lower, it's very possible that the consumer on the high end will start slowing down as well. That's going to speed our descent into a recession likely later this year. I heard you mention the GDP numbers. Those were surprisingly weak after a 1.5% reading to be cut to 0.7. That's a warning sign. You throw in additional inflation, and that dreaded word of stagflation pops up very clearly. I think that will be the case. And I do think by year end, we're now in a recession officially by the numbers. And so again, you look at all the factors, right? I mean, we have the private credit markets that are crumbling at this point. I mean, I think that quote at the beginning from Bank of America said it perfectly. Just in 2008, you had oil prices spiking and the credit crisis was beginning. You have the makings of this dual factors exactly like that. Now, I'm not saying it's going to be exactly like that catastrophic event. But ultimately, it leads us down a path to tell us what is likely coming. You throw in defaults on credit cards and auto loans being at major highs at this point. There's a lot of signals that are now telling us that the consumer is getting crushed. And once the economy starts to slow, it's going to spiral into that recession. What I'm seeing is, and right now the Fed Watch tool, it's pricing in one rate cut in September, I believe, of this year, and then no rate cuts after that until I believe a year later. I think they're going to come faster. And I'll tell you why is because